So as we already know that at this level, they will test you international investment appraisal, not the domestic investment appraisal. As we have already seen that there are a lot of concepts of basic capital budgeting are used in this international investment appraisal, along with some new concepts like use of exchange rate, royalty treatment, intercompany transfers, tax treatments, and along with other concepts of inflation, working capital, relevant cash flow will all be there. They will able to produce only 50, and after that 80. In the price they will sell is 750 and 150 markup upon a cash production cost. So what this information will be used for? They are giving you 150% markup. Can you tell me what is the point of this information? This information can be used to calculate the cost because it is markup. So 150% markup is always percentage of cost. So its cost is 100. Markup is 150. Selling price is 250, and accordingly you can calculate the cost in 750. To all of you, let's practice today one question of investment appraisal on the Excel. So this question is here from Kaplan study text. It's an exam level question on international investment appraisal, right? So as we already know that at this level, they will test you international investment appraisal, not the domestic investment appraisal. As we have already seen that there are a lot of concepts of basic capital budgeting are used in this international investment appraisal, along with some new concepts like use of exchange rate, royalty treatment, intercompany transfers, tax treatments, and along with other concepts of inflation, working capital, relevant cash flow will all be there. Understood? So this will be a good practice. Let's read the requirement first. It says evaluate the proposed investment in France. Evaluate the proposed investment in France and recommend what investment decision should be made in Puxty Plc. State clearly any assumption you made and work all calculation rounded to the nearest 10,000. Now, this assumption thing is quite frequently asked all of you in AFM exam. They generally, after solving entire question, they want you to write the assumptions you have taken while solving it. So, as an assumption like discount rate assumed to be constant for entire life of the project, inflation assumed to be constant, or you can suggest some things to reduce uncertainty like sensitivity analysis, simulation, etc. So practicing 1-2 assumptions writing will help you write different types of assumption question in exam. Now, Puxty Plc is a specialist manufacturer of window frame. It means main UK manufacturing operations based in south of England, okay, from where it distributes its product throughout the UK. The director now considering whether they should open up an additional manufacturing operation in France, which they believe there will be a good market for their product, okay. A suitable factory has been located just outside Paris that could be rented on a 5-year lease at an annual charge of 3.8 million. Okay, so they can rent out a factory on an annual charge of 3.8 million, payable each year in advance. The manufacturing equipment would cost 75 million, of which 60 million would have to be paid at the start of project. This manufacturing equipment, my friend, would cost 75 million and 60 million need to be paid start of project, and balance 15 million need to be paid after 1 year. You can see, so the initial payment of 75 million need not to be paid all together. It need to be paid in 2 installments. 60 million at time 0, 15 million at time 1. Very good. That's something different. At the start of each year, the French factory would require working capital equal to 40% of that year's sales revenue. So working capital is 40% of revenue, nothing new. We already have done similar type of questions. It is expected that the factory will be able to produce and sell 80,000 window units per year. Although in the first year, because of need to run in machinery and its new workforce output is only expected to be 50,000. Each window is likely to be sold 750 at a price represent 150 markup on cash production cost. So this is a typical exam question, all of you, with a lot of information. Although with wordings, with a lot of wordings, you should not get confused in exam. The relevant thing you have to catch up, which is that 80,000 window will be sold every year. But at the year 1, it will be 50,000. After that, 80 they will solve. Because in the year 1, they are saying that because the need of running machinery and its new workforce output only expected. So maybe due to certain issues, in the first year, they will able to produce only 50. and after that 80. When the price they will be sell is 750 and 150 markup upon a cash production cost. So what this information will be used for? They have given you 150% markup. Can you tell me what is the point of this information? This information can be used to calculate the cost because it is markup. So 150% markup. Markup is always percentage of cost. So if cost is 100, markup is 150, selling price is 250, and accordingly you can calculate the cost in 750. Right? Further, the French factory would be set up as a wholly owned subsidiary of Puxty Plc. Okay. The France 25% SLM depreciation on cost is an allowable expenditure against company tax. Corporation tax payable at 40% without delay. Any unused losses can be brought forward for setup against in the following year. No UK tax would be payable on after tax French profit. Interesting. They are saying that depreciation is tax allowable and depreciation rate is 25%. So we have made an investment of 75 million on which we will get a depreciation of 25 million, 25%. It means we will get a depreciation in 4 years. 25% means the entire value will be finished in 4 years, 25, 25, 25, 25. In the 4 year, we will get entire depreciation of our initial investment. Okay. Corporation tax is payable at 40% each year end. And so one more simplification. Tax is payable in the year itself, it is incurred. So no lag or arrear case. But rate is 40%. It means they are charging at a very high rate. You don't have to pay extra tax in the UK. You already paying a very high tax in the France itself. So all amount in euro are given in current terms. Okay, now inflation is need to be adjusted. All euro terms, euro amount are in current terms. Annual inflation in France is expected to run at 6% per year in foreseeable future. All euro cash flow involved expected to increase in line with inflation rate, with the exception of factory rental. So factory rental you don't have to inflate. The cost of manufacturing the equipment, even the cost of manufacturing will not be changed. They will remain unchanged. Okay. The French factory would be producing a window to special design patented by Puxty to protect its patent rights. So this is a point of royalty, now. Puxty Plc will charge a French subsidiary a fixed royalty of 20 per window. This cost will be allowable against the subsidiary French tax liability. No issue. The current spot rate is 1.5. Inflation in the UK expected to be 4% per year over the period. There is no remittance restriction between France and UK. Puxty Plc is an all-equity finance company that is quoted on London Stock Exchange. It is share beta value. It's given annual treasury bill expected rate. So this is given to calculate the discount rate. Do you know what is this? CAPM, capital asset pricing model, which says, although we have not discussed CAPM till now, but I think most of you are already aware from your earlier studies that CAPM is risk-free rate plus RM minus RF, return on market minus risk-free rate into beta. Puxty operates on a 5-year plan horizon. At the end of 5 years, assume that working capital will be fully recovered and the production equipment would have a scrap value at the time 70 million before tax. So there will be a scrap value and which will be 70 million. And since our entire asset is depreciated, is 70 million will be our balancing charge. The 70 million will be balancing charge or not? You have to pay tax on this 70 million. It's a gain for you. So the entire 70 million is a gain. Proceed on asset or sales are taxed at 40%. It is also given that proceeds on asset sales are taxed at 40%. Assume all cash flow arise at the end of year to which relate unless otherwise stated. One interesting thing, in UK, tax is payable 35% 1 year earlier. So in France, they are paying tax in same year. But in the holding company, the parent company, UK, the tax is 1 year earlier. Okay. So let's see how to deal with such type of questions. Now, always make examiner clear that you are doing in thousands or millions. So I always prefer to solve question in thousands. So I'm writing thousands for 1,000 for examiner. Let's write the year first. Obviously, right now you are solving this for euro, the France country, and then you will convert it to UK. Pound, right? So you are solving in euro. 0, 1, 2, 3, 4, 5. Right? Let's start with the revenue figure. All Everything is marks. Even though you don't understand, always start the question. Don't wonder on one or two lines and stuck to it. It's okay if you're not able to crack that one line. What is the issue? So in the first year, the unit sales given in the question was 50,000 or 80,000? 50,000. Price was 750. Agreed. The price was how much? 750. Sorry, let me be right. 50,000 into 750. And if you remember, the inflation rate given in the question is 6%. And to convert in thousands, let's divide it by 10 to the power. If you want to convert in million, divide by 10 to the power 6. But since I want to convert it in and also convert in thousand, that's why. Also give power, so this formula can run. Give reference to the power 1. So automatically this inflation rate for every year will be powered. Now move this, but all this will be wrong answer because from the second year unit you have to change. Just make sure you change. Now the unit sold will be 80,000. After that, these units are right. So check out. Any doubt in this? Check out the formula 50,000, 750. If you want, I hope you remember the information. 50,000 window in the first year, then 80, 80. Each would likely be 750 price. And inflation, they have given 6% since all euro data is in current terms. So we will assume this 750 euro is also in current terms. Secondly, operating cost. How do we calculate operating cost here? In the question, they have not directly given us operating cost. We have to use a 10th class funda. So we know that we are now quite old to remember the concept we have studied in our 10th class, right? So let me help you. Percentage. Working note 1. So it says 150% markup. So markup is, it means cost is 100. Markup is 150. Markup means profit. Profit is 150. It means selling price is 250. So in 750, if I want to calculate the profit, 750 multiply by 150 or cost multiply by 100. How will you calculate? 750 is your selling price in the question. So you have to multiply it with 100 to calculate the cost and divide it by 250. Remember this point. 750 into 100 divided by 250. Or you can do it directly also. You can calculate operating cost directly. This multiply 100, which is cost, and remove the profit selling price. 750 is equivalent to 250 as per percentage. 15,900. Put a negative sign if you want to show operating cost in a minus, and Control C. So it will. I'm rounding up just to make sure they look nice. You can round off all together also. Even in exam, this rounding of facility works. And doesn't matter whether you round off or not, you will not lose marks. This is not just for my comfort. Okay. So operating cost. Done with operating cost or not? I hope this basic mathematics is not creating very issue to you. If it is, you have to give it a little bit thought. I don't want to invest too much time on this at this level, right? Very good, all of you. Done. Right. Now, after operating cost, there is a rental charge in the question, right? And rental charge is not inflating. 3.8 million, 3.8 million, they have given in million, but I'm not writing in million. So 3.8 million is equivalent to 3,800 in thousand, right? So rental charge. When we talk about rental charge, 3.8 million, inflation will not be there. One more thing I think I remember that the rental charge is payable each year in advance. Yes, this point, advance, not in arrear. So it will start from year zero itself. I hope all of you notice this. Yes, sir, we have already noted. Good. So control C and E. Right. One more interesting point to note here. Most of the students miss this point. See, from the time value of money perspective, you are paying first in time zero. Then in year one, year two, year three, year four, you are right. The first cash flow will go right now itself. But from tax benefit perspective, you will get deduction of these 5 payment in the 5 year itself. This first payment will get deduction in the first year, the second one in second year, third is third year. So for tax, advance and arrear doesn't matter. For tax, it is a matter of how many payments you make. If you make 5 payments, you will get the benefit of 5 payments in 5 years. You will not say that first this 0 year payment and 1 year payment will both the benefit will come in first year. No, even though you are paying in advance, it will be considered for tax purpose the payment of that year, and the payment you made at the end of at the beginning of the first year. Sorry, at the end of first year or the beginning of second year will be considered as the payment of second year. So this is basically for tax purpose. You have to remember that point. I will discuss this again when we will going to discuss tax. Let's put the debt also. Depreciation is also very easy. They have given 25% and 75 million was our investment. So negative 75 million will be 75,000. Just add 3 zeros. Divide by 4 because it was 25%. So 4 you will finish this in 4 years. Don't need to run up to 5 years. Regarding fifth year balancing allowance, balancing charge. So in this question, we don't need to apply the concept of balancing allowance, balancing charge because the value of the asset is already diminished to zero. And the impact of balancing allowance, balancing charge on the scrap value, we can take out separately. We will do it separately because question says scrap value is taxed at 40%. And in this question, entire scrap value is the gain. So we can separately take scrap values in inflow and then separately minus the tax on that scrap value separately. So it will, we don't need to have a concern here to adjust in the fifth year right now itself to complicate more. Okay. Now this will give us operating profit or operating cash flow before tax. What? Some. Right. Have we missed anything here? Now remember, in exam, if you missed anything, there are two ways to adjust it. One is to add the row or column, like I added here, but it will not work in exam because in exam you cannot. This shortcut is not allowed. That's why I removed it. What you have to do, you just have to copy from where you want to create and put it little bit down. Now you have space. So I missed royalty, right? As you are pointing out, I missed royalty, right? So where is the adjustment? What is the adjustment I need to do for royalty? How much is the royalty in the question? So 50,000 into 20. And royalty is given in pound. And we are right now in euro. So how to manage all this? Have they given us the exchange rates? Okay. It means we have to perform exchange rate calculations now. Before solving this question, we need to do exchange rate calculation. Lot of stuff to calculate. Second note, calculation of exchange rate. Now, exchange rate calculation is very much important for us for year zero. Let me write. And I will recommend always make exchange rate calculation vertical like this, not horizontal, because it will help you. It will ease your work. You will know. You will know so. If you remember the inflation rate formula, multiply 1.06 divide 1.05. Sorry, 1.05 or 1.04. UK expected 4% and there is no. So the inflation of UK is 4%. So do you understand what I have done here? Now just simply Control C, Control V. It will automatically do it for you. 2, 3, 4, and 5. If you want to round it off, you can easily round it off also. At least have 2 points open, so you will be able to understand the difference. So last year value, I hope you remember the formula. Formula for S1, the purchasing power parity. I'm using the formula for purchasing power parity, which is S1 is equals to S0 into 1 plus, since it's a quotient of year, I have taken 12-month interest rate. If it was 6 month or 10 month, I have proportionated the interest rate also. To multiply in bracket 1 plus inflation of quote currency. So if you notice, they have given you £1 is equals to 1.5 euro. So quote currency is euro. For example, $1 equals to 50 rupee. Rupee will be quote currency and dollar will be price currency. Sorry, dollar will be base currency. So divide by base currency interest rate and multiply by quote currency. Inflation of quote currency divide 1 plus inflation of base currency. Right? See, £1 is euro. £1 in euro. £1 is the currency euro is per pound is spot rate is 1.5. Now you have exchange rate. You can use these exchange rates. Royalty. How much is the royalty? 20 pound is the royalty. Now next question may arise, sir. Are we going to divide or multiply? Now that is after doing entire forex question. That is not a question you should be worry about here. You know that you will multiply. So 50,000 into 20, multiply the exchange rate, give reference, sorry, year 1, and divide by 10 to the power 3. So this should be your answer, all of you. Agreed? Run this. Yes, sir, you have done one mistake. You have not converted secondary 80,000, right? Let me correct. So royalties and outflow for this France company. Okay. So this is the calculation of operating profit. And interestingly, in the first year, we are getting loss. Are we not? In the first year, Are we getting loss or not? We are getting loss. So how to continue now? How to continue? In the question, it is given how to deal with loss also. They have helped us out. They have already given us that how to deal with loss, how to deal with loss, carry forward for the next year. So let's calculate tax. In the first year, it will be zero. Now in the second year, I want to apply tax of 40% on this, but I already have a loss of this. I will minus this loss. Remember, I will minus this loss from this profit for the calculation of tax because I will not pay tax on entire this profit. I have loss in the previous year government. So government will help me get, government will reduce, right? Now this year, there is no adjustment is required. Directly multiply tax. Control C, Control V, put a negative sign. Understood. Now, in the final year, there is one thing you should note. If you remember, we got deduction of this 38, this 38, 13800 deduction is not given. For the tax purpose, I told you that you have already get a relief of 43800 payments, but you have made 53800 payments. So tax will give you benefit for this 3500 in your final year. This minus the 3800. And multiply tax rate of 0.4 negative. So this is your tax calculation, my friend. 6071714 and this. Remember, sir, can you explain again the tax calculation? Definitely, we can discuss it again, all of you. First, sir, why the first year tax is zero? Because there is no profit. So what you have done with this loss? Adjusted with second year profit. You can see. And just for the tax purpose, I'm adjusting. Actually, it's not an outflow. That's why I will not actually minus from the profit. But for the tax purpose, I need to reduce the profit. Then simply calculated. Now some of you must have confused, sir, why you minus 3800 in the fifth year? 3800 is not an outflow fifth year. Why are you minusing? Tell me, how many 3800 payments you have made? How many rental charge you have paid? 5. But for tax purpose, you claimed only in the 4 years. So what about the payment you made in advance at the 0 year? Will that payment is not a payment for tax? Is it not an expense for tax? That is also an expense now. That first 0 you are getting in the first year, the first year payment in second year payment in third, fourth year payment in fifth. So basically, this fourth year payment benefit you will get in the fifth year. And in third year, you are getting the fourth, the second, third, first, second, and 0 first. That's why. Understood? What's more, sir? Now just calculate other things. Initial outflow was in the question, if you remember. Sir, how much was the initial? 75 million was the inflow, but 60,000 you done in the first 0 year, and remaining 15,000 you done in second year. Sorry, 0 and first. So scrap value, you have ignored scrap value totally. You taught us about balancing charge and balancing out, and you have done nothing. 70,000 is your inflow. Okay, I'm adding now. Comfortable. And you also want me to have a negative tax impact on this? Yes. 0.4 taxes need to be paid. So I have separately done this. When there is no value to carry forward in the fifth year, now you can always do this. Because in the final year depreciation, there is no point of depreciation there. There is no value of the asset left. So to simplify, do this separate calculation. Sir, what about working capital? What about adding back depreciation? Right. I need to add back debt. Where is the depreciation? Although in the question you should always read if they are saying that you are also doing capex of the same expenditure, then no need to add back. But here no such line is written. That's why we will add back. Now, only I think only one adjustment of working capital left. Only one adjustment of working capital left. So for working capital also I can do in one cell itself, but for simplifying, let's do. So question was saying that working capital is some percentage of revenue, right? 40% of revenue. I can easily do this. I have done the reference of revenue calculation of working capital we are doing. And how should we do the calculation of working capital? We will continue this discussion working capital. Let's take a 5 to 10 minutes break. I got some urgent work. Let's take a 5 to 10 minutes break. Then we will continue this discussion. So try to calculate yourself till then. We will resume in 5 to 10 minutes. Okay, let's resume everyone. So we have discussed working capital. We were discussing calculation. So in the question we have copied revenue. For the working capital, the question is saying it is 40%. No, 40% is the tax. Somewhere they have mentioned regarding working capital also. Okay, sorry. It says at the start of each of the French factory would require working capital 40% of revenue. So how to solve this? They require working capital required you have to calculate. So it will be 40% of revenue at the start of the year. So if we make one column of year also, to give you better understanding, 0, 1, 2, 3, 4, and 5. So this year into 0.4 they need like this for every year. Now what you have to calculate here is the change, all of you remember. But you have to calculate is to calculate change. Change is always old minus new. Automatically you will get your working capital. In the end you will get the recovery. Whatever amount left will be recovered. So just give reference to the change. Right. Now this is your working capital. Correct till now? Everything is right. Then calculate net cash flow in euro. Remember this cash flow is in euro. Equal sum right net cash. Now you cannot calculate NPV. That is the importance of investment appraisal question, that you have to calculate first these cash flow in pound, and then you have to apply NPV. So first brought back all that cash flow in your home country and then perform NPV IRR calculation, whatever it is required. So exchange rate Now again we require exchange rate, and since we have already calculated, let's give it a reference from our calculation. Then net cash flow in pound. So this divide this. Then now we already know no extra tax in UK, no extra tax in UK. UK tax rate is much lower than France as per given question. Royalty is the income. So the royalty which they were getting is 50,000 into 20. That's income. So 50 into 20. But there is a tax rate in the royalty. 0.35 is the tax rate. So 0.35 is the tax rate. Sorry. So they will left with 0.65. 650 it will be their royalty income. Not in the first year, right? Sorry, we cannot do like this here. You know why? Because tax is 1 year lag. The tax is of 1 year lag here. The 0. 1,000 you will receive 50 into 20. For next 5 years. But tax you will have to pay 1 year later. 0.35. So 1 year extra tax need to be paid. Put a negative sign. Understood? Then calculate net cash flow. So is a loss in the first year. If you talk about the discount rate, because now you also need discount rate. So you will use CAPM for discount rate, which is RF plus bracket RM minus RF into beta. So cram this formula for now. All of you don't understand this. How much is the RF? Treasury, UK government treasury bond is risk-free rate 10%, market is 18%, and beta 125. So 10% plus bracket open 18% minus 10% into 1.5. Right now. So this is our calculation. $1.25, sorry. 20%. Now just apply the NPV formula. Rate, comma, range from year 1. Then separately add the negative outflow. Coming in percentage, let's convert it into number. Positive, except the project. And finally, once you have done this practical discussion with, for examiner, all the question will not end just by discussing the practical things. You also have to write assumptions. Like for example, um, royalties are subject to UK tax. We have assumed that UK tax is payable on royalty, and royalty are allowed. Um, we have to perform sensitivity analysis on various data to know the volatility or variability of that data. So a lot of other assumptions we have taken, and accordingly we will frame your answer. So this was our practice of Excel. I hope this question is now clear to all of you. We will discuss further concepts in next class. Let's complete our discussion here for today. Take care, tata all of you.